Hello again. Welcome back and thanks for watching. It's been a busy week this last week. Lots of things happening, not necessarily with sales, but of course with interest rate cuts and whatnot. I do have statistics from across Canada that I will get into in just a moment. Actually, as I started to record this video, I had a ring at my doorbell. So I answered it, and it was just some random contractor looking for work. He's got no business right now, and he has to find work. So he knew I was a realtor, and he's just given me his resume and said, "Hey, if you got any work, let me know." So is this a sign of the times? Most likely. I just talked to some random truck driver on the weekend, and he said the business is very slow right now. He does long haul to the States, and he said it's been very slow, and yeah, things are pretty quiet for him too. So last week we had our first interest rate cut. And as you know, in one of my previous videos, I think it's too soon. I didn't expect it, but there was some new data that came out between when I made that video and the actual announcement, some GDP data that wasn't too good. So I think there was just that too many things that the Bank of Canada felt they needed to cut the rates. I still think it's too soon. I think they should have waited at least another month. We all knew it was coming at some point. It's actually something that I've been waiting for. And if anyone that watches this channel knows, it's one of the signals that things are heading in the right direction, at least for buyers anyway. Now, one of the reasons I think that they did cut a little sooner than I thought they would is because they're trying to engineer this soft landing, something that has never happened, by the way. It's always a hard landing. And a landing, even a soft landing, if you think about the terminology of soft landing, it means the economy is hitting the ground just softly instead of with a big crash. So it's still not a very positive thing for the economy. But anyway, they throw that term around like it's some good thing, but it's not a good thing. Any landing or hitting the ground with the economy, I guess that's what they're talking about. Where else do you land on? You land on the ground. Is not good for the general economy, businesses, unemployment, all the rest of that. It is good if you're looking to get into the housing market and you still have a job, which 90% plus of you still will. So now I want to talk about the lead up to the cuts briefly. So last year in the beginning of the year, they were talking about cutting at the end of 2023 or in the fall. Then it was the spring. Finally, we did get a cut. Many people wanted it, including politicians, which were opening their mouths, which they shouldn't have been, because it wants to lower payments for people and make things more affordable. Well, a 25 basis point rate cut isn't really going to make things that much more affordable, maybe $100 or so on the average mortgage, but that's not much when these average mortgage payments have risen by $500, $1,000, $1,500, and even more in some cases. So anyway, we have this big lead up. Everyone's waiting for the cuts. We've been talking about this again for months and months and even a year. And when it's going to happen, and this is going to happen, and that's going to happen. Well, they finally made the cut, and what happened? Nothing, because everything has already happened prior to the cut. So nothing happened. I would say less than nothing happened. Now, I have some charts here from some preliminary data for June from the Toronto Real Estate Board and the ITSO, the 20 board surrounding the GTA, and this is what the data is saying. So the first chart here is the sales to new listings ratio. I calculated the ratio based on the number of sales in the green and the number of new listings in the blue. And you can see for June so far, this was as of yesterday. I did this a couple of days prior to that too. It was 25%. So it has crept up just a bit. But this is the first 10 days in June. It's 27% for the Toronto Real Estate Board, the sales to new listings ratio, which is deep into buyers' territory. You can see the other months there I just did for reference this year, and they started out almost at 50%, and they have been creeping down, and now June is abysmal, 27% so far. I do expect that to creep up somewhat, but again, pretty low. Now moving on to ITSO. ITSO's in a buyer's market also, and not as bad as Toronto Real Estate Board. But again, they were all in the healthy 40s. They did start to slow down, 42% in May, and now they're at 39%. So what happened was everyone was expecting, or the narrative was, not my narrative. My narrative's different. Obviously, you know that if you watch this channel. But everyone was waiting for these cuts, and all this flood of buyers was going to happen. These buyers are going to jump into the market. We all know that's not what happens. Historically, when you cut rates, Prices fall with them. The economy is in trouble, and they're doing it for a reason. And a lot of people actually have caught on to that in the last few weeks. A lot of major players or major voices in the industry. I won't name them by names, but I've seen a lot of that on X, especially where I spend a lot of time, where they're actually, informing their viewers or their subscribers, their followers, that this is what happens. The prices don't take off when rate cuts happen at this point in the cycle. And of course, all the pieces to the puzzle are slowly falling into place. Here is the latest bank sales, and I did this as of the week of June 2nd. And you can see they're at record highs on the active bank sales on ITSO and TREB. TREB's at 287 and ITSO's at 109. ITSO is just a little bit higher than the week before, but the week before that was, or the month before, I do them monthly or every 3 weeks or so, whenever I can get around to it. But you can see it was higher than it has been since January 16th, 2023 on the blue ITSO, and TREB is higher by far than since I started tracking back in June last year. And of course, because of that rate cut, I had to update my home buyer recipe. So let's take a look at that now. Now, someone did call me out on the falling prices to say, well, they haven't really fallen that much. And yeah, I could probably back that off a bit. But again, they are falling. They have fallen since the peak. So I'm leaving that as a green checked mark. They're definitely not increasing at this point. Now on to the falling rates. So we had the first bar because of the talk of the falling rates. The second one that I just added last week was because they actually cut the rates. As they continue to cut, I will keep adding bars. Now, they won't continue to cut if the economy or something turns around and inflation rears back. But if they do continue to cut, it is because of the shape of the economy and what's happening. And again, it's all part of that cycle. Next, some other big news last Friday, I believe it was, unemployment crept up again to 6.2%. I didn't add another battery bar into this. I'd like to see it over 6.5% before I do that. But again, unemployment is still creeping up, playing out as the cycle should. And lastly, the mortgage arrears and delinquencies, they're not high. They have crept up from their all-time lows, but again, haven't moved in the last update, which again was Friday, I believe, and it's still at 0.19% for all total mortgages with the 11 or 12 big banks, whatever they track. So very interesting things that have happened in the last week or so. Everything is falling into place. Everything is playing out as it should. This is not unexpected. Again, if you watch these videos, this is how the cycle plays out, and they'll do everything they can to avoid the worst. But again, cycles play out the way they should. They can postpone them and slow them down and do whatever they try to do, but it always ends up the same. Now on to the statistics from across the country. And we have a mixed bag here, and it's pretty interesting seeing the areas that are up and the areas that are down. Now, these are from May, so we have the month-over-month price change from April to May here. And one thing you do have to remember is May is peak spring months. So, of course, we're going to see a lot of month-over-month increases here. But again, we do see some declines too. So the declines starting with Brantford, down 9% in Brantford. Kingston and area, down 4.5%. Huron and Perth, down 3.9% month-over-month. Barron District, down 2.1%. Ottawa, down 2.1%. Halton, down 1.9%. So a lot of big areas there that are down month-over-month. Then you get into Woodstock, Ingersoll, 1.6%, Peel down 1.3%, Windsor, Essex down 1%, Southern Georgian Bay just 0.5%, York Region almost 0.5%, Montreal is flat, Hamilton, Burlington just up a bit, pretty flat. A lot of flat places in that 1% range on the upside. Durham Region up 0.7, Calgary up 0.7, Province of Quebec as a whole up 1% month over month. Saskatchewan up 1.2%. They're at an all-new high. Actually, a couple places on here. We'll get into that in a second. Simcoe and District 1.3%. Kitchener and Waterloo up 1.4%. Niagara Region up 1.4% month over month. Peterborough up 2%. Guelph up 2.2%. Edmonton up 2.2%. Another one of those areas with an all-time high again. Fraser Valley up 2.5%. Grey Bruce, Owen Sound up 2.7%. Lakelands, Muskoka area up 3.3%. Greater Vancouver up 3.4% month over month. Victoria up 3.8% month over month. Toronto up 4.9% month over month. Cambridge up 5.2%. Okanagan 5.9%. And Chilliwack and District up 7.7%. So we're seeing a lot of these Western areas, BC and Alberta, they are up. They're doing very well out there for some reason. The markets, I don't know why. There's a lot of people, actually, if you read in the news, they're leaving BC or they want to leave BC, like 20 or 30% of the people that live there because it's so unaffordable. But again, they're making all-time highs, some of these places, and a lot of the other ones are up big in May. Now moving on to the average change from the peak. How much are they up or down from the peak? And this is as of, again, May this year. So Ontario got hit the worst with everything because they had the biggest price gains. So Brantford down almost 25%, Woodstock down almost 24%, Southern Georgian Bay 23.5%, Berrien District 23.3%, Durham Region down 23%, Cambridge 21%. London, St. Thomas, 20%. You got a bunch in that 15 to 20% there. Kitchener, Waterloo, Guelph, Huron, Perth, Halton, Peterborough, Fraser Valley, Hamilton, Burlington, Simcoe District, Niagara Region, York. Then we have Kingston down 13.5% from their peak. Lakelands just under 10% from their peak. Again, they fluctuate wildly because of the waterfront properties that come on the market in the spring. Ottawa down just under 9%. Chilliwack District down 8.1%. Victoria down 6.5%. Interior BC Okanagan down 3.6%. Toronto down only 3.5%. Montreal tied for their all-time high. Calgary up 0.7% from last month, which was their all-time high. So now, of course, May is their all-time high. Province of Quebec up 1% from their all-time high. Saskatchewan up 1.2% from their all-time high. Greater Vancouver up 1.8%. And Edmonton up 2.2% from their all-time high. Now looking at that in dollar terms. Durham Region down 283,000. That's a lot of money. Halton Region down 269,000 on average from their all-time high. Peel down 264,000. Southern Georgian Bay down 263,000. York Region down 240. Berrien District 236. Brantford 225. Cambridge 219. Fraser Valley down 214,000. They seem to be the worst or the biggest losers out of the West Coast there. Woodstock, Ingersoll down 205,000. Guelph down 192,000. Kitchener, Waterloo down 190. Hamilton, Burlington down 168,000. London, St. Thomas down 165,000. Grey Bruce, Owen Sound down 151. Windsor, Essex down 145. Niagara Region down 137,000. Huron, Perth 134,000. Peterborough down 132. Simcoe District 130. Victoria, 108 grand down from their all-time high. Lakelands, Muskoka, 104,000. Kingston and area, 99,000. Chilliwack District, 73,000. Ottawa down 67,000. Toronto down 44,000. Interior BC, 27 grand. Montreal, again, they're tied. Calgary up $4,000 from their all-time high. Saskatchewan also up $4,000 from their all-time high. Quebec province up $5,000 from their all-time high. Edmonton, $10,000 new all-time high for May. And Greater Vancouver reached an all-time high, which I was really surprised. They weren't far off, but they did reach another all-time high, $23,000. Now, their detached didn't reach an all-time high, but when you combine all property types, it does calculate into an all-time high. Now, those were the best numbers that 2024 is going to offer. Again, this is spring. These are when the all-time highs usually happen. So, of course, we're going to see them all decline from here on in, most likely. Now into the market balance, the sales to new listing ratio for each of these areas I just discussed. We're seeing a lot more areas into the buyer's market now. Southern Georgian Bay, Peel, Lakelands, Toronto, York, Windsor, Essex, Berrien District, Halton, and Niagara Region, all in buyer's markets. Then you have all the balanced market. Now, if you look at the balanced market areas, they're all listed there. More than half of them are closer to the buyer end of this. So they're very close to buyer's markets, but they're still in that balanced market area. Then as you creep up to the seller's market, you start to see the western provinces or the western areas, and of course, Montreal and Quebec. Now, we don't have any overheated seller's market, which we usually have for places like Calgary and some of the places, Edmonton, I think it was. But again, there is no overheated sellers, just regular seller's markets now for those remaining places. And if you're wondering what my background is this week with the danger, the construction area, this is in Niagara. I'm going to be doing a video about this probably on Friday to release it. It's one of the most recent condo developments that has just entered into receivership. So I will be talking about that later in the week. But for this week, that's it. Leave me your comments below as always, and I'll see you next time.